full disclosure that we have not had an opportunity to do a lot of prep for this, so I'm perfectly happy
Oh,
to wing it. But just want to have a sense of kind of what you're hoping to cover today.
totally. I mean, I'll also just toss this to any other folks from the grassroots housing working group. But I just think, starting with maybe 10 minutes from each of you all, sort of maybe a little bit about the sort of sector you're working in as lenders. And, for me, the stuff that, I think you all have been super helpful in thinking about is, what does a capital stack look like? How do you take a sort of nonprofit affordable housing structure, whether it's a CLT or a co-op, and make it recognizable to lenders? How do you especially get a project off the ground? I think that those are the sorts of things that are super useful, and in particular, from your perspective, what you're looking for, and also what kind of services and support you all are offering. And, especially, I mean, there's folks from a few different places around Indiana and beyond on here. So again, just kind of an introduction to the sector and what affordable housing funding can look like as well.
Okay. So I just put the topic in the chat. Can't get more vague than that.
Sure.
And the purpose of these monthly calls have been first to lead up to the summit in March, but just to give a general overview about each month, it's a different topic. You can assume a lot of folks here are, I call it, I have a friend who's a Southern Baptist consultant. He talks about fixing to commence and to get ready. Um, Folks are thinking about what they might do, and one of the big ones is how would we pay for this? So if that helps with context, have at it.
It does. Josh, maybe if you wouldn't mind me chiming in first and then bringing you
Please
in
go ahead.
yeah, thank you. Good afternoon, everybody. My name is John Zody. I'm the executive director of CDFI Friendly Bloomington. I was at the Grassroots Housing Conference in March, and so I was in some of the breakouts where we talked about some of this, and some of the discussion was, as Aaron said, some folks are in different places about in the continuum of affordable housing and resourcing projects and what organizations do and mean what. And we talked through, acronyms and all that kind of stuff, some of the basic things. And so that kind of leads us maybe into your obviously your monthly sessions and how we look at affordable housing. And the bottom line, I would say, is building relationships like this is really important because there's always someone who knows the answer. It may just not be one single person or organization. So my background is in government and higher ed, and I was previously the director of housing and neighborhood development at the city of Bloomington, which is where I first met Hugh. I didn't know Josh yet, but have interacted with the Center for Rural Engagement. I see Gabriel Pizer on here, and just knowing how to bring some of those folks together is a really important piece of this. And so when I transitioned over to CDFI Friendly Bloomington, that became more important to focus on because we are an entity that cannot usually single-handedly finance a project. And so we've got to bring in partners. And my job is to bring in partners and help complete this sort of capital stack and be a resource. So our organization, if you don't know what CDFI means, it stands for Community Development Financial Institution. And the friendly means that our job, my job, I'm a one-person shop right now, is to know what projects are going on in the community development world in 13 counties in South Central Indiana. So we cover Bloomington and basically the surrounding 12 counties all the way down to Crawford County, which is on the Ohio River. And so my job is to sort of wave my hands in the air and say, hey, organizations and financial institutions, there are all these exciting projects going on in community development in South Central Indiana. Please think about investing. And my job is sort of a matchmaker. So if there's an affordable housing project, I will look at where the stack of financing. So what is the group of money that's going to get that project done and off the ground? And particularly, and more specifically, my job is to help bring in community development financial institutions to this part of the state. We've had a really large gap in investment from these institutions in this part of the state. There are lots of CDFIs around the country. There are about 1,400 of them, and their job is to be mission-based lenders. Most of them are nonprofit organizations that have been around for varying times, but the CDFI movement started in the late 60s and sort of evolved through the 70s and 80s. But they started as organizations for people who were unable to get lending for their small business or for their mortgage or for housing because of systemic factors, right? So discrimination and redlining, all the things you talk about with during the late 60s and civil rights movements. We are trying to, they were created to sort of fill that gap. And so now they've evolved into a $250 billion sector of the finance industry and can make an impact on affordable housing, on financing small business, and be creative about it. And so the value of CDFI financing is its ability to be nimble and flexible and to work with the borrower to get projects done, and sometimes unique projects. So I'll fast forward a little bit, and one organization, our nonprofit, our CDFI friendly, and the friendly is the matchmaking, right? So when I'm out there saying, hey, CDFIs, look at this cool affordable housing project like Bloomington Cooperative Living is doing, and they'll come in and say, okay, well, we're going to take a look at this and maybe we'll finance it. One of the organizations that we've worked with is Josh's organization, which is Local Enterprise Assistance Fund, or LEAF, which is a CDFI. And so there are about 1,400 of these organizations around the country. And so building relationships and helping them understand what's going on the ground is our contribution to this effort. And then we have a loan pool that we can help make low interest loans as part of that deal at times. And so Josh and Hugh and I, and more so Josh and Hugh and our organization before I came on board, worked together. Now we've done 3 deals or four deals, guys. Yeah. And so we'll talk about those, but we've worked together and been able to partner on some loans to get the projects done. And so it's a creative way to get affordable housing done. And I will say, so far it's been on a smaller scale, which is really important. Not every affordable housing project can be a large 50, 60 unit tax credit project where you get low income housing tax credits. It's really important to look at incremental development and how we infill and rehabbing properties, which is one of the first project. The first project we worked on was a rehab in Bloomington. And how do we do this in a sort of a small, scalable way to really impact affordable housing quickly? And more quickly sometimes than a tax credit project, for instance, can do. So let me stop there and maybe throw it to Josh and go from there.
Great, thanks, John. Yeah, and thanks for spelling out many of those acronyms so that I don't have to. Yeah, so as John noted, LEAF is a CDFI. I'm a loan officer with LEAF. We operate nationally and are headquartered in Boston, Massachusetts. But we've had the pleasure of working on 3 projects in Bloomington and collaborating with you and with CDFI Friendly on each of those. So as John noted, CDFIs, sort of generally speaking, are mission-based loan funds, usually nonprofits. We are a nonprofit that emphasize sort of providing financing at sort of affordable and flexible terms to projects with a high social return, with a social impact. That are generally unable to access financing through more sort of traditional banking markets, but which despite sort of having a perceived higher risk by the traditional financial institutions, are important for communities, right, and affordable housing and small business development. LEAF's sort of particular focus, kind of within that mission-oriented sphere, is on community ownership, meaning largely cooperatives as well as community land trusts and other sort of related organizational types. But the focus for us is on providing financing for businesses and organizations that are directly owned by and controlled by their immediate stakeholders. What I mean by that there are sort of 3 primary sectors that we operate in. One is worker-owned cooperative businesses. So small businesses that are owned by and controlled by their immediate employees, rather than outside investors. We provide financing for food cooperatives, which are essentially grocery stores that are owned and controlled by the immediate community that shops there and relies on that resource. And then the third, and the one relevant to our conversation today, is housing cooperatives as well as community land trusts that provide affordable housing, and that are owned and controlled by the residents who live there, as opposed to to being sort of owned by a landlord as residents. So the first two projects we have worked on in Bloomington were with Bloomington Cooperative Living, which is a housing cooperative. Hugh sits on the board of BCL, and the third project that we are currently working on is another housing development through the Avalon Community Land Trust, which is a separate organization, but related in its mission objectives as well as personality. Is our you mentioned sort of speaking about kind of the capital stack and sort of how these transactions come together. So in a very general sense, the capital stack for these sorts of cooperative housing or kind of other impact projects is not terribly different from sort of traditional housing development in that you have a combination of debt and equity. A loan fund like LEAF, of course, provides the debt portion of that. The equity portion, where these projects so differ from more traditional development, is typically not provided by sort of profit-seeking investors, but by a combination of sort of the immediate stakeholders themselves, the residents, the employees, sort of the members of that entity that is seeking financing. Sometimes, community supporters in the form of donations or sort of concessionary investments, as well as public subsidy, which was an important part of the projects we worked on in Bloomington, grant funding through the city's affordable housing trust fund. But essentially, the difference between debt and equity being that equity is sort of the portion contributed by those closest to the project that is not sort of expecting sort of immediate repayment, is more sort of flexible and patient in its repayment expectations, and represents the sort of what we call the skin in the game, the sort of the portion of money that is sort of being brought to the table by the project's stakeholders. And we then leverage that by providing debt financing that is conceptually similar to that which would be provided by a bank, but we take I would say we take a quite different posture from sort of traditional for-profit banks in terms of the flexibility of the terms we can offer. Most importantly, the flexibility of how we underwrite or sort of analyze the projects. We are able to take risks that banks wouldn't, and finance projects that would not be eligible for bank financing because we are committed to mission and sort of weight that in our consideration. And probably the biggest sort of technical difference between the sort of loans that LEAF provides and what a bank would provide for a housing development such as this is that we provide what's called non-recourse financing, which basically means that if something goes wrong in the project, our ability to sort of our security, or what we can then kind of pursue, is limited to the assets held in the project itself, meaning sort of the real estate being developed that is sort of put up as collateral. What we do not require or expect is that there be some other party, sort of a sponsor of the project that is able to put up a guarantee, meaning that if the project goes bad and that the value of the collateral doesn't cover the loan, we can't typically go after the sort of individuals in that cooperative or the organization developing it, which is both sort of a practical reality that these these organizations typically don't are sort of limited in their resources and their ability to provide such a guarantee. If they could, they would probably be going to a bank. But also from a sort of mission some consideration, our whole sort of mission is oriented around collective ownership and collective self-governance. And it's not really fair or realistic in our minds to expect that there be sort of any individual who is sort of assuming the debts of that collective And so that is sort of something that we forego, that a bank or a more traditional lender would certainly require. And it's what makes it possible for us to finance these sorts of projects. It also, as you might imagine, exposes us to greater risk, and that is sort of that's our business model. That's important for sort of getting these high impact projects done. It also means that our business model is really dependent on sort of trusting relationships. That we are a very sort of relationship based lender. It's important that we get to know the communities in which we operate, that we get to know the folks developing those projects. I would say that as far as sort of, that speaks to the services we offer that go beyond the immediate financing. We really view ourselves as partners in these sorts of projects. We'll go out of our way to sort of provide, advice, coaching, connect folks with sort of additional resources. And it's, that is in part why the relationship and partnership with CDFI Friendly Bloomington has been so valuable to us, because they are on the ground in the community in a way that we're not, are able to help sort of facilitate those relationships, and sort of help us get comfortable with not just the sort of financial profile of the projects, but that there is sort of a strong network of community support behind them. So I'll pause there. I could sort of ramble on all day, but I'm excited to be with you all and to the engaging in dialogue.
If I could just pick up one point sort of initially before moving into just totally open discussion, but what I would like to kind of maybe pull from both of you all a bit more is, maybe on this track of thinking about relationships. And it's just to say that with both of your all's institutions, also I'll mention other sort of non-bank lenders like cooperative structures like shared capital. One of the things that's really struck me is the kind of willingness to support projects and applicants to help them think through how to creatively assemble a capital stack. And that follows from what you're saying, that these are not, sort of conventional, often these aren't conventional projects where the sorts of guarantees, are immediately legible to a bank, but the fundamentals beneath them are strong, by which I mean that there's, in many of the cases, and I'll say just looking at who's on this call, I think that, Aaron's exactly right, that there's a bunch of projects that are potentially on deck that really just make a lot of sense, that they meet real needs for affordable housing, that there's already some equity, that there's strong organization. But the question is how to shoehorn all of those things into a kind of deal or a project that makes sense. And so I just wanted to maybe ask you both for just, to talk about what you kind of expect from applicants, and also what kinds of conversations do you think make sense? I mean, that, in other words, to say that I've really benefited from conversations with you all and with other, non-traditional lenders where you kind of help us think through the process. And, I think that for people who haven't been through this before, that's one of the most intimidating things, right? To think that you have to come totally buttoned up with an unconventional project, whereas my experience is really the opposite, that, for the reasons you laid out, that you're willing to sort of talk through a project and figure out how to cross all the T's and dot all the I's. So anyway, I just wanted to sort of you all to talk about that in terms of kind of literally how to get started with financing.
Yeah, I think, if I may, one thing that I just can't stress enough, I guess, as a former government guy, that, building those relationships and what your point of entry is into housing finance is really important. And then looking at where you fill the gaps from there. So as, like I said, I first met Hugh when I was at the housing department in Bloomington, and I was managing a lot of federal money. And we also have a housing development fund in Bloomington, which is pretty unique in the state. Not a lot of cities have that. And so Bloomington, I think, has a particular focus on innovation or helping fund unique projects through its housing development fund. It's a lot more flexible money. Federal money, as we talked about in March, has a lot of strings attached to it, and the regulation is very intense, especially with housing, environmental review processes. And prevailing wage laws that come into play, and all kinds of things you have to think about with federal money. And so getting relationships built with your local governments and also your state government through the Office of Community and Rural Affairs, who manages community development block grant funding. So who in your community manages those funds? So if you're in the city of Indianapolis, that's the Department of Metropolitan Development. If you're in a community of less than 50,000 somewhere in the state of Indiana, the state of Indiana manages that money. Otherwise, it's administered directly through the city. So they get their allocation directly from the U.S. Department of Housing and Urban Development. And so when you're thinking about how to put all that together, one partner that we had, Josh and Hugh and our organization had, was the city of Bloomington. This latest project that we did, the new construction project, had $140,000 in. Hugh, you have to remind me if it was officially a grant or officially a loan, but either way, it was very, very low cost financing, if any, from the city's housing development fund. So that filled a big piece of the gap, right? So they had financing from our organization, financing from Josh's organization, and then they had a lot of equity that came in through basically a grant at the city of Bloomington. And so putting all of those things together, you have this, a natural question for the organization is, okay, what do I have to do to stay in compliance with you guys? What do I need to do with you guys? What do you need to do with you guys? And so luckily all streams of financing here were pretty low. I would say low on the regulatory front, right? But when you start bringing in federal money, it's really important to figure out early what those regulations are and what the guidelines are ahead of time, because timing is so important with housing and housing development, that getting in on the front end and getting those relationships built and knowing what you're in for, quite frankly, with certain types of money is super important. And that's where we can help, right? So understanding the timelines for certain regulatory things, or how long it takes to close a loan or to underwrite a loan, and just putting all that stuff together is where the relationships come in. So hopefully that answered part of Hugh's question.
Yeah, I would say from our perspective, most of the folks that we work with and provide financing to are first and foremost organizers, and are typically not, experienced real estate developers or finance folks. And we feel like, an important part of what we can bring to the table is not just money, though of course money is important, but is also some of the sort of technical know-how to help kind of channel that organizing into a really, viable, financeable project, because we've done this a few times. And our work with BCL was no exception to that. In fact, a kind of a great example. When we first connected with BCL in 2019, they were a bunch of really passionate, engaged organizers who had a vision for what they wanted to do, but were not ready for a loan, and did not have a lot of sort of financial expertise or experience. I mean, the books were kind of a mess, and I sort of asked them to produce a pro forma, which is a sort of financial model for a real estate development, and they were like, "What's that?" And that's not unusual. So we are sort of committed to kind of putting in the work and the effort to kind of help folks get there when we see that, when we see the potential, when we see that sort of there is the relationships, the trust, the vision in place. As long as we can kind of approach it in the spirit of sort of mutual partnership, we want to help hone those projects into something that can really be built. In the case of BCL, what that meant in our case was, referring them to, an experienced consultant who had worked with housing co-ops to help sort of tighten up some of the internal financial controls to a level that, we would require. As well as helping them really kind of workshop and build up that profile, sharing some of the templates that we've used, helping sort of understand, the assumptions and kind of data points that feed into it. It took a year of working together that way to get to a point where, we felt confident that this was sort of a viable project that the organization had the capacity to execute on. And it did. If we had sort of made a loan, after that first meeting, I'm not sure it would have been successful. But after kind of working to build up that capacity, that knowledge within the organization, and of course, leveraging the energy, the commitment, the relationships that they already had, we were able to get something built, and something really special. I see a question from Ryan to explain what a pro forma is. A pro forma, and this is, the pro forma is one of the sort of very first documents that we'll request. So that's sort of a good starting point for this conversation. It's basically a spreadsheet that kind of models out how the development will take place and will repay the financing that has been used. Really kind of looking at sort of the numbers and the finances. So when you're contemplating a real estate project, you need to think about the physical design, like the architectural drawings, sort of what it's going to actually cost to build it and the materials that go into it. You need to think about the kind of legal and regulatory elements, like under the city's zoning code, can you actually build this? And then, of course, you need to think about the financial considerations. How much will it cost to build? How will you finance it? Like, what will be the sources of capital you're obtaining, and then how will that be spent? Sort of what's your development budget? And then, sort of a critical piece of that is going to be the operating pro forma. So essentially, once you've got it built, once you have folks living there, how much income will it generate in the form of rent or kind of co-op fees or however that's structured? What will be the expenses associated with operating the property? Real estate taxes, insurance, repairs, making sure you're sort of budgeting adequately for kind of whatever may come. And then, what's going to be left over? And will that be sufficient to, repay the loans, the investments that have been taken out to finance it? So that's sort of a critical starting point to kind of assess the feasibility of a project, and sort of model out how it should perform. And then, of course, reality has a funny way of getting in the way, but that's kind of the basis on which we will sort of analyze the project's viability and the kind of template to which we will then compare, sort of actual performance.
And Ryan, everyone, I'm putting in the link, a link, or in the chat, sorry, a link to a housing webinar series that the Regional Opportunity Initiatives organization does. ROI, that organization, is Housing Out of the Community Foundation here in Bloomington, and I'm in this group of organizations that has a regional community economic development focus. And so this series of housing webinars has several topics, but a couple of them are about pro forma and how to do one for multifamily housing and how to do one for single family. So I'm going to put this link in the chat. It's really a great series, and they were done. A lot of them were done during the pandemic, so they're done on Zoom. And one of our colleagues here in Bloomington does one of them. So I'm going to put that in the chat if it's helpful. They're pretty good to kind of get an idea of some of the basics on this.
I'll also add, there's the Center for Rural Engagement created a document called the Housing Ready Toolkit, which talks about a lot of different parts of housing development. But there is a section 12 of the document that I'll drop into the chat, talks about the sort of very basics of a pro forma, has an example of a detailed pro forma, and I think might even have links to some templates that you can use. But I'll drop this in the chat as well for folks who are interested.
And I'll say there's like a gazillion, pro forma templates out there on the internet that you can kind of download an Excel workbook. And, some are very complicated in sort of the world in which we operate. They often don't need to be too complex. We're not dealing with sort of, many layers of investment and sort of massive developments. I would say the sort of critical thing and where there's kind of a lot of back and forth is sort of once you have a handle on kind of the pro forma model and how it fits together, is then making sure the assumptions going into it are really solid. And that's where we'll often sort of be asking a lot of questions and kind of, tuning it up. There can be a temptation to sort of, put in assumptions that kind of make the project look good, that sort of, will suggest it will be viable. But, we always want to sort of err on the side of conservatism because the last thing we want to do is sort of set anyone up for failure. right? We want to make sure that those assumptions are not only sort of realistic, have a reasonable margin for error. To make sure that once we sort of get past the spreadsheet and really break ground and this thing is real, that it will be positioned to sort of deliver for those community stakeholders. A kind of certainly in the case of BCL and other projects we've worked on, we started with sort of a rough model and kind of honed it over time as we sort of did research together as far as what would be sort of reasonable to expect.
I'm sorry.
Well, I was just going to say to sort of Josh's point about pro forma and just the transactions and timelines. So separate from this project that Hugh and Josh and I are talking about, we helped around the same time, we helped an emerging developer in Bloomington acquire an existing apartment building. And when I say building, it was kind of a big house, right? And that was for sale. And so if any of you are thinking about, hey, I'd like to acquire this property, or you don't currently own it and you're looking at acquisition, timing is super important, and giving yourselves plenty of lead time to line up financing for an acquisition, because you've got that underwriting. If you're going to a bank, you're going to a CDFI or whatever, you've got to work with the buyer and seeing what their purchase or their sale timeline is, and whether you can get a purchase agreement in place that will afford you the time to get financing lined up. And you may not have a lot to put down. And so how is all this going to come together? And so we helped an emerging developer, worked with another CDFI to do an acquisition loan. And then the property is basically paying for itself through vouchers. The residents are living there on veteran housing vouchers. And so, because her goal is to house people affordably, not so much to make money, but she's building an asset. But the timing was really important on there. And we went back and forth a lot about, the purchase agreement had to be extended and all that kind of stuff. So when we're talking about smaller scale development and trying to get a hold of properties, timing and financing is really important. So think long and hard and kind of give yourself plenty of lead time when you're looking at that, and hopefully have a flexible borrower or a flexible seller who's willing to amend a purchase agreement maybe if needed to get financing in place.
So
in general,
and Josh, you answered the question, but I'm going to ask it anyways for both of you. So most of the folks I talk to are congregations. They want to do something in housing. They literally don't know where to start or who to talk to first. It sounded to me, Josh, like you're sort of a good starting point to give them the landscape and even other people to talk to. Is that a safe assumption, or?
Definitely. I'm always happy to talk with folks, even if they're not ready to apply for a loan at this moment, and get a sense of sort of their vision, their goals, their objectives, and we can sort of help to provide kind of advice ourselves on how to go about it. We also will very likely kind of then make an introduction from there. Our primary role is as a financing entity. We do provide some of that advice ourselves. But there are others, including I think some folks on this call, where that sort of that kind of advisory role and providing that kind of support in terms of how the project actually gets sort of structured and executed is their primary expertise. We have many of those folks in our network. And so, often the sort of first step is to kind of make an introduction and say, like, look, this is, this is the project these folks are trying to kind of pursue. Here's, the role that we could see Leaf playing and supporting it. But also, here's kind of what we would need to see for it to be eligible. And do you think you could help be a partner in getting it there? So yeah, we're a great starting point, and we may kind of pull other folks into the fold as well.
I ask that because people don't think about going to a bank to have them help walk them through the steps.
Well, and Aaron, depending on where those congregations are, sometimes there are sort of regional or localized community development organizations that are engaged in that effort. So I know, the first one that always comes to mind in Indianapolis is Martindale Brightwood, and in Tend, Indiana, is a CDFI, and they started as a neighborhood community, and that's sort of in the Kennedy King Park neighborhood
Sure.
in Indianapolis.
I
They
know.
started there and
Yeah.
grew into an intent. And so, there are CDFIs working around the country and in Indiana, and some of them are local. Not every community development corporation is a CDFI, but a lot of them are engaged in that. So starting local and understanding, and I don't have to tell you all this because you're all trying to get this done in your backyards and in your communities. But I think just reemphasizing the importance of knowing what's going on already. And then because money is scarce, whether it's grants or loans, and I think that's important to know kind of what else is happening out there, which again is I'm preaching to the choir on that. But those starting points, Josh is an awesome resource, and Leaf does work all over the country. So just getting those different points of entry is really important.
And right, like, candidly, like, we don't get paid for the time we spend doing that, but that's why we're a nonprofit. We're committed to the mission. We have different motivations than a bank would have. We're always happy to sort of have those initial conversations.
And a CDFI, to maintain its status as a certified organization, it has to have a mission of community development and has to provide development services and technical assistance, not just financing. I mean, Josh is talking about that's part of the mission, and so that is our job to be helping folks through this process. And whatever it is, right? If we're introducing you to somebody or just getting together a Zoom, an email introduction, whatever it is, just to connect dots for people's project can be really important.
Maybe on that topic, John, just what you were saying, could you share a little bit about, and really other folks as well, when you're thinking about kind of assessing the impacts of the housing projects that you finance, especially sort of like, because it's sort of mission driven, I'm imagining it's, it's sort of the social and the economic, environmental, the sort of broad kinds of impacts that these projects can have. What does that kind of assessment look like as you're kind of trying to track the impact that a mission-driven lender is trying to have?
Josh, you want to?
Sure. Yeah. I mean, in the context of a housing project, the most fundamental sort of unit of analysis is affordability. Is this housing that low income folks and low income households can afford to live in? How low income? There's a broad spectrum of that. How many units are going to be created in the community? So that is sort of the starting point. In our case, given our sort of unique focus on community owned and community controlled housing, we're also looking at aspects of sort of how is the organization governed? Sort of what is the role for participation, by the residents? What efforts are made to sort of create, a sort of culture of, kind of collaboration? And there's quite a broad spectrum in the co-ops we work with. Some like BCL are really committed to the concept of co-living and have a high level of sort of participation, engagement by their members. Some co-ops, that's less the emphasis. And there's more sort of focus on just like, we want housing that's affordable. We want housing that's accessible. Folks may have their sort of relationships with one another, but that's not as much a sort of core part of the mission. And there's no right or wrong. Both are fine. But there being a sort of meaningful element of, resident control over the sort of, kind of management and outcomes of the housing isn't to us. And we're somewhat unique in that way. Related to that is we want to understand what mechanisms are in place to keep the housing affordable. We don't want to see sort of affordable housing develop that then just gets, flipped to the market 2 years later. So understanding sort of what are the controls in place to ensure that the project stays true to its mission is important.
I would say, Gabriel, as a regional organization, we are geared toward a larger goal of impacting housing in the region. So there was a housing study done. ROI, Regional Opportunity Initiatives, did a housing study that about, Gabriel, but others, there was a regional housing study done that said this region, 11 of these 13 counties in the next 10 years need 16,000 units of housing in different price points, right? And a lot of those were affordable. And so everything we do regionally is geared toward that, right? How is it impacting that study, for instance, when you're applying for grant funding, or when you're talking about the importance of this stuff? What drives a lot of that is orientation toward a larger goal. We're doing the same thing with daycare and things like that. But as Josh said, it's impacting affordability in Bloomington. Bloomington, as you all know, is a small college town with a really tough housing market. And so, and we have a lot of new apartment buildings, most of which are not affordable. And so how do you impact that housing on a small scale? How do you chip away at providing housing availability? It can't all be new construction, and preserving affordability has to be almost just as important as new construction. And how do you get that done? And so that really, when you're able to say, this many housing units were preserved in a city where it's really hard to keep property on the market, meaning it gets snatched up really quickly. We have 30,000 rental units in Bloomington. So when you put a house on the market, it can easily get snatched up by a landlord that will make it a market rate rental house. And so anytime you can say we preserved affordability, you are basically taking those units out of the market and keeping them affordable instead of them having go market rate. And that's the competition the tension we are constantly dealing with in Bloomington. And we have a lot of good landlords, but another unique piece of Bloomington is measuring the impact of housing safety and what that concept means outside of Bloomington. As soon as you step outside the city lines of Bloomington, there's basically no housing regulation, because there's very little housing regulation across the state. And so in the other 12 counties in our region, there's no regulation saying, housing standards have to be X, Y, and Z. We have a really robust rental inspection program within the city to protect those 30,000 units and have a standard of safe housing. But what is that standard outside of Bloomington? And that's a really important function when you're looking at getting unique financing in place, getting unique partnerships in place, knowing that multiple groups are invested in maybe one small scale development. And so there are many people aware, and there is a standard there that hopefully brings the standard of housing up a little bit, because our housing stock is suffering too in a lot of the regions. So we've got to be thinking about housing safety as well.
Well, that's Gabriel, you specifically mentioned like environmental considerations, or if there are others you enumerated, and I'll say that anything sort of beyond the kind of core concept of affordability and community control is kind of gravy to us. It matters. We consider, we're sort of interested in sort of what other value a project creates for the community, whether that's in terms of like environmental sustainability, whether that's in terms of sort of creating an intentional community for sort of folks who have been historically marginalized one way or another. Like we're sort of interested to hear the motivations behind the project, and sort of how it serves particular communities' needs, and we factor that all in. But that we don't have sort of the kind of hard and fast requirements around that. Affordability is sort of the one like bright line.
That's great. That makes a lot of sense.
Okay.
And I mean, this is a related question. Well, maybe I'll give another couple seconds in case other folks have questions.
I actually do have one point of clarification, as I'm still learning all these finance terms. Does the CDFI have its own funds to contribute to the project, or are they mostly serving that function of like convener and like resource and relationship development?
Yeah, great question. We do have our own funds that we lend. So we're not a very big fund when you compare us to like private sector actors, but we are capitalized with funds and are available to make direct funds. Without going sort of too deep into the weeds, we're what's called a revolving loan fund, which means we have a sort of permanent pool of capital that's provided by a range of sort of mission aligned investors, including the public sector, including private foundations and impact investors, And that is, money that, is that we sort of have to directly lend as it gets, repaid. We re-lend it to new projects. Unlike a bank, we don't have depositors. We don't sort of obtain money from like consumers who sort of deposit their money with us, which means that we are not regulated the way a bank would be because we don't have consumer deposits at risk. And that is what enables us to do some of the riskier, more alternative projects that that a bank would be unable to do. So we do have capital, and it comes from sort of mission-aligned investors, and that's to who we are accountable. So they don't want us to lose their money, but they want us to do projects that are high impact.
And Stephanie, our organization, so we are a CDFI, but we primarily focus on the dot connecting, the matchmaking, if you will. We have a loan pool, but we have to loan that in partnership with a CDFI like Leaf. And I want to point out that there are two more of us in Indiana. So there's CDFI friendly South Bend, who covers St. Joe, Elkhart, Marshall, and some of LaPorte County, I think. And then we have a CDFI Evansville region. So around the Evansville area in Southwest Indiana, there's another organization like mine that works to bring CDFI financing into our area. So they both have what are called enhancement funds, which is the loan pool that I'm talking about that we loan in partnership with CDFIs. They're in different places though. So depending on where you are in the state, reach out to them and you can talk about that. We sort of operate those differently and they're in different stages because our organizations are in different timeline stages, but it is a good question. Thank you, Stephanie. I see Hugh's hand up.
Yeah, I mean, I'll just be very brief because there's two more questions in the chat that I think would be very useful to address. But one thing I wanted to maybe highlight is that, especially for folks who are outside of real estate development or haven't dealt with housing financing before, I think kind of a really understandable psychological kind of impulse is to look for a moonshot, right? Is to say, like, how can we solve this problem of needing $1 million to, save this co-op or make this project possible? Whereas part of the kind of concept of the capital stack is that it actually can be helpful to diversify risk and make sure different organizations are signing on. And that, for example, one of the cooler things that BCL did, I think many people on this call know, is getting 50 microloans of $1,000 each as part of our capital stack for our 21 bedroom. And that was part of showing to shared capital that we had a lot of community input and it provided cash equity. So I wanted to just maybe ask you both and anyone else if there's any kind of genuinely mind-bending contributions to capital stacks that you've come across, like just things to help stretch people's sense. I mean, we've talked about federal grants, local grants, CDFI funding. There's like co-op oriented lenders and investors like NASCO Properties and Shared Capital. But if there's anything else that you could just share, to kind of illustrate what a diversified capital stack looks like.
Yeah, I mean, Hugh, you touched on some of the important ones. I guess two others I'll note that are maybe more exceptional. Like, these are not part of every project, but like can be really valuable. One would be crowdfunding, meaning sort of investment that is raised in sort of small dollar increments from a broad base of local supporters, typically at concessionary terms. I mean, that can range anywhere from straight up donations to investments that the goal is to repay, but which folks, sort of need to understand, and there needs to be transparency around, are risky investments that, will not yield a market rate of return. And folks, are motivated to make such investments, because they want to, support the project's initiative and sort of see it get built in their community. And there are, there have been, within the past decade or so, legislative reforms that have made that easier to access. There are sort of online platforms that facilitate it. So that has played a role in some projects that we've financed. And I'll note that, that is valuable both for the dollars that it brings to the table, but also to demonstrate a broad base of community support. That means that there is sort of a broad kind of coalition of local stakeholders who, have sort of not just supported the project, but kind of put their money where their mouth is. And it means that it sort of demonstrates that there's local support behind the project and a network of local investors who may be able to sort of kind of offer material support as the project goes along. Whether that be sort of simply helping to get the word out, showing up to public meetings to support it, and so forth. Those sort of things that are hard to measure but are really valuable. The other one that can be really important is just concessionary sale terms. Folks who are willing to either donate properties or more often sell it at a discount to the market value. Because they support the organization's goals. And I mean, Aaron, you mentioned that you work with a lot of congregations. This is something that has come up in that context, where a lot of churches and synagogues own land that they would like to see housing built on. And they're willing to contribute or sell that land at sort of below market terms in order to help the project get done. So those sort of discounts relative to the market value of the property can be considered sort of an investment into the project anyway.
I would say when we're talking about CDFIs and what they are, some people say, well, what do they do? And I will say a lot of times, well, it's almost a better question to ask what CDFIs won't do, right? Because they have such ability to be nimble and to work with different models and different financing structures and thinking about the projects that we've done with Leaf and thinking about the one I told you guys about with the acquisition. South Bend is doing some really interesting things with a CDFI with small emerging developers who are trying to need a gap filled in equity. Like they're basically flipping properties and they need equity, like an equity injection as they flip, and then that loan gets paid back. So they're sort of short-term financing, like bridge loans, where you're going to get revenue, you're going to sell or rent or whatever in a defined period of time, and you just need the money to get you started, or bridge money. And certain CDFIs will do bridge loans, or certain ones will do pre-development loans, where you need money up front to get something done. And so there's just all kinds of creative models out there. And I think here in Indiana, Prosperity Indiana is a good group that has access to CDFIs, and those conversations are active with Prosperity Indiana, for instance. I'm happy to make more connections with CDFIs as well, Aaron, if we want to do another session like this and have Josh and a couple of other CDFIs on to talk about different housing types, something like that. I'm happy to help set that up, and I'm sure my colleagues in South Bend and Evansville would be glad to be on there too. So there's just a lot. There's always more to learn, right? And so, Hugh, what stuck out with your question is how do you stretch those dollars? And the local city money from Bloomington coming in to shave off the top what you guys needed to finance is really beneficial, and just, reducing the amount of money that you've got to pay back later and getting the project off the ground. I think that's really important, and finding grant sources, which are always competitive, is really important. So anyway, so I think that's, and
John, mark your calendar for March 21st. That's the next
Okay.
summit.
Okay.
We just identified our first topic and presenter.
Which is who?
You.
Okay. All right. I'll check the calendar. So anyway, that's it's really, I'm just engaged in so many conversations here in Bloomington about incremental, kind of small scale development, and that's what you guys all seem to be trying to do. And I just can't emphasize the importance of it enough. So yeah, glad to keep talking.
In the last 3 minutes, does anybody else have a question? While you're thinking, I just want to repeat, we're not meeting in December. So the next one of these conversations is January 22nd, again, a Wednesday at noon, and we'll be talking about capacity building. And mark your calendars for March 21, 2025, all day, Farm Bureau Insurance Building again. We'll try to take the next step from last year's So
I'll just adding to the question that's in the chat from Galina. I'm curious, just as we close, for grassroots organizations that are trying to develop some literacy around this stuff, are there? I know that we shared the webinar up in the chat, but are there books or other websites that you would recommend, or even just sort of topics that you feel like would be really helpful for people to be better versed in as they start to explore this and make approaches to folks like you?
One that I'll plug kind of off the cuff is NASCO. So NASCO.coop. NASCO is the North American Students of Cooperation. They're one of the national organizations that provides a lot of support and advocacy, not financing, but kind of playing that organizer role for housing cooperatives. And their website, again, NASCO.coop, has a really deep resource library that is worth exploring. Everything from template bylaws to pro forma models to lease templates, like conference presentations. There's a ton of stuff on their website that's worth sifting through. And they are just great folks to know as well, and have been a major ally for this space.
could you say that
The
again,
link is
Josh?
in the links in the chat. NASCO.
NASCO.
But I dropped a link to their resource page in the chat.
Great, thanks, Gabriel.
Well, thank you, folks. Happy Thanksgiving, happy holidays. See you next year.
Thanks,
Yeah.
everyone.
Thank
Thank
you,
you
John
all
and
for-
Josh. This was
Yeah,
great.
thank you all for the presentation. It was extremely helpful, and
Yeah,
thank you everyone
thank you
for
so
attending
much.
today.
This was a pleasure. Thank you all for your interest.
Thanks.
Thank you.
See ya.